Jim Walker, founder and MD at Asianomics, who joins us now on the show from Hong Kong. Jim, hi, morning. While the Fed has delivered on expected lines, the world is a little puzzled as to why emerging markets as well as U.S. markets are seeing a sell-off today.
Well, I think I'm not that puzzled about the US selling off. I think as the year goes on and the Fed keeps reducing the amount of purchases that they make every month, US equities are very vulnerable. At the same time, I must admit I'm slightly puzzled by what's going on in emerging markets, not in Argentina and Venezuela and Turkey. These places really should have sold off long ago. But generally, I really don't think people need to be that worried about quantitative easing being tapered off if they live in the emerging market universe, because it's going to focus us back onto fundamentals, and the fundamentals in the emerging markets are actually still pretty positive. So this is a buying opportunity.
Jim, if world's biggest economy is making a roaring comeback, which is US, which is a $14 trillion economy, why is that bad news?
Well, I wouldn't say it's making a roaring comeback. I think the stock market last year made a roaring comeback, but if you look at the economy, basically for the last 4 years, given the amount of stimulus that's going into the US economy and the amount of monetary easing, it's the worst economic growth that they've had over a 4-year period in the last 40 years. So it's hardly making a roaring comeback. Only the stock market would suggest that. If you really measured unemployment in the way that it should be measured, rather than just because people are dropping out of the workforce because they can't get jobs, the unemployment rate in the US would still be over 10% today. So I think the US is growing around about 2% a year, but that's hardly roaring.
Jim, you track China as well pretty closely. How big a concern is the PMI data?
Well, it's just one of the elements in the concerning story about China. Certainly, I think this year that PMI, which came out this morning at 49.5, could easily be the best PMI that we see in China this year. In our view, the economy is going to slow pretty rapidly as a result of the government getting to grips with both the shadow banking system and basically the overall credit addiction, which has become de rigueur, if you like, in China. It's become the norm. It's required for the economy to grow. But it's growing in all the wrong directions, from local government offices to property that doesn't produce anything to steel capacity that can't be sold. So China really has to change direction here. I think the government knows that. And the direction that's going to change, and I'm afraid, is a downwards one. It's going to follow the pattern that India has gone through over the course of the last couple of years, and could easily get to the kinds of growth rates that India has experienced in those last 2 years.
Jim, do you think today's sell-off in emerging markets is more psychological? Because Fed tapering does not mean tightening, and they will still continue with their bond buyback program. 85 becomes 65, but that 65 is still there.
Yeah, I would set aside the quantitative easing stuff and really just focus on exactly what you're mentioning, that this is psychological. The psychology, and it's quite bizarre psychology, the psychology is that emerging markets have been the great beneficiaries of quantitative easing over the last few years. Emerging markets have been underperforming developed markets for the last 3 years. And in some instances, like China, for example, the stock market there has gone nowhere for 5 years. So, there's a real myth that has surrounded quantitative easing and its impact on emerging markets. Emerging markets, before quantitative easing was ever contemplated as a policy, were rising relative to the developed countries. So the sooner we get rid of quantitative easing and get rid of this psychology that it's the money flows around the world that make emerging markets go round, it's hardly that at all. We can get back to the norm of looking at emerging markets, looking at the growth rate that they're producing, looking at the corporate earnings that they're producing, finding out that these are actually somewhat better than in the developed countries. And then the money flow will naturally come back into the right areas of the emerging market universe.
Jim, why are you insisting that one should have a glass half full approach?
For India, I think it's very clear that the Indian economy has slowed quite dramatically over the last 2 years. Companies have been caught out by that. Their balance sheets have been somewhat suspect. Their debt levels have increased more than they would like. But what they've begun to do over the course of the last year is actually repair that position. And what we've seen with Indian companies is that they have begun to improve their balance sheets again. They've stopped capital spending. That increases free cash flow. Eventually what that results in is a stabilisation in the economy as companies become much more comfortable with their own fundamental financial positions. And that's what we're telling clients just now. India has gone through part of the process of restructuring and rebalancing at the balance sheet level. We expect that process to continue for another quarter or so. But by the middle of this year, calendar year, we expect that India's economy will have bottomed. Companies will begin to look much, much more attractive, especially the ones that have sold off a lot over the course of the last 2 years. And India will bounce back.
Right.
It tends to dance to its own tune anyway, and we think it's going to be dancing quite strongly by the end of this year.
Okay, India should be dancing, but let me tell you that why the music should stop, and that could be because of the debt problem. Most of the Indian companies or most of the Indian stocks which are beaten down, the problem with those stocks or with those companies is that they are sitting on debt and they don't have cash flows.
Yeah, that's always a problem. And of course what we've begun to see is that companies have cut back on their capital expenditure. That's precisely the kind of thing that companies need to do in order to improve their cash flow position and then make it much more easy for them to service their debt. So what you would really be looking for at the moment, I would say, for companies to buy are the ones who are cutting back on capex, beginning to restore their balance sheet again, and those are the ones that will stabilise the economy. If anybody's still spending loads of money on capital expenditure with high debt levels, then I think they would be problem companies. But the whole process of India repairing itself, I think, is now well underway. It seems bad at the moment and it looks bad at the moment, but give it 6 months and it will look much, much better.
Meantime, the finance minister commenting, saying that they'll take whatever steps necessary for financial stability right now. US Fed's decision to taper bond buying was on expected lines, and that the RBI and government is vigilant in terms of how to achieve financial stability. Foreign inflows continue to be robust and India is in a comfortable spot. Jim, what's been your view after what we've seen from the RBI governor this time? Unexpected as it may be, a rate hike, but do you think the governor was only ahead of the curve this time around? And more importantly, going by your assumption that the economy is going to bottom out by FY14 end, how imperative would a rate cut cycle to begin would be for that assumption of yours?
Not imperative at all. In fact, I wouldn't be assuming any rate cuts even this year. It's quite possible that we'll see further rate increases. But our point would be that at this point in the cycle, companies are not borrowing anymore. They're not increasing their capital expenditure. They've been reducing it for a year. And when that happens, then, of course, interest rates actually become somewhat irrelevant. It's one of the great myths of the global economy these days, and you hear it all the time from central bankers, I'm afraid, and especially in places like Europe, that we need a credit upswing before the economies can then grow again. That's absolute nonsense. There's never been an economy which has gone through a recession where credit has led the economic growth cycle. It's quite the reverse. An economic growth cycle recovers on the back of corporate earnings improving, balance sheets improving, and companies becoming comfortable again with their financial position, then starting to stabilise, then starting to grow capital expenditure from retained earnings. So it doesn't actually matter anymore what the central bank does for interest rates in India. The economy will be improving regardless of interest rate levels by the middle of this year.
Jim, so let me throw one more ingredient in the melting pot, so to speak, which is what is happening to other emerging markets. And also let me take the clock back. As of now, everyone is of the view that what is happening in Argentina and Turkey will not have impact on India and China. But we saw a similar kind of an argument before the financial crisis in Asia. The problem started with Thailand and then it spread like a contagion. Why do you think this time what is happening in Argentina and Turkey will not have a contagion effect?
Well, there were very real reasons for the contagion to spread through Asia in 1997-98. Thailand was by far the worst of the countries in the region in terms of its exposure to external debt and the fact that it had a raging current account deficit. But that was also true of Indonesia. It was partly true of the Philippines. It was very true of Korea as well. Not the current account deficit bit, but the borrowing offshore. Even Malaysia had taken on far too much external debt. If you look at the emerging markets just now, there are clear problems in places like, obviously, Argentina, Venezuela, Turkey, a very specific problem with the current account position there. But elsewhere, there have been problems in India for the last few years, and they're now improving. The problems in Southeast Asia are limited to Indonesia. Elsewhere,